Two Canadians. Both earned $10,000 in investment income last year. Same country, same tax year, same amount of money. Canadian A paid approximately $3,900 in tax on that income. Canadian B paid approximately $390 in tax on the same amount. That is a $3,510 difference on identical investment income. Canadian A did not make a mistake on their tax return. Canadian B did not do anything illegal. There was no loophole, no accountant's trick, no offshore structure. The difference came down to one thing: what type of investment income they received and where they held it. Because in Canada, not all investment income is taxed equally. Interest income, eligible Canadian dividends, non-eligible dividends, capital gains, and foreign dividends are each taxed at completely different effective rates. And the gap between the best and worst taxed types of income at a middle-class Canadian income is enormous. This video explains exactly how Canadian dividend taxes work, why eligible Canadian dividends are among the most tax-efficient forms of income available to everyday Canadians, how the gross-up and dividend tax credit mechanism actually works, and, most importantly, the account strategy that lets most Canadians make dividend taxation almost completely irrelevant. By the end of this video, you will understand something that most Canadians who have been investing for years still do not fully grasp. Before we get into dividends specifically, you need to understand the full landscape. Because the reason Canadian eligible dividends are so tax-efficient only makes sense when you see what they are being compared to. Canada taxes 4 types of investment income at 4 completely different effective rates. Let us run them all through the same scenario. A Canadian earning $80,000 in employment income in Ontario, receiving an additional $10,000 in investment income. What do they actually pay in tax on that $10,000? Type 1. Interest income. Interest income from GICs, savings accounts, bonds held outside a registered account, is taxed as ordinary income. It is added directly to your employment income and taxed at your marginal rate. At $80,000 Ontario income, the marginal rate on interest income is approximately 39.16%. Tax on $10,000 in interest income, approximately $3,916. This is the most heavily taxed form of investment income in Canada. Every dollar of GIC interest earned in a non-registered account is taxed at the same rate as your paycheck. Type 2. Foreign dividends. Foreign dividends from U.S. stocks like Apple, Microsoft, or an S&P 500 ETF held in a non-registered account are also taxed as ordinary income in Canada. They are added to your income at full value and taxed at your marginal rate. Tax on $10,000 in U.S. dividends in a non-registered account, approximately $3,916, same as interest income. Note, there is also a 15% U.S. withholding tax on U.S. dividends paid to Canadians, which can be partially recovered through the foreign tax credit. But the Canadian tax treatment remains at the full marginal rate. Type 3. Capital gains. Capital gains, profit from selling an investment for more than you paid, receive preferential tax treatment in Canada. Only 50% of a capital gain is included in your taxable income. This is called the capital gains inclusion rate. On $10,000 in capital gains, only $5,000 is added to your taxable income. At a 39.16% marginal rate, the actual tax paid is approximately $1,958. Effective tax rate on capital gains at this income level, approximately 19.58%. Type 4. Eligible Canadian dividends. This is where it gets interesting. And this is the category that requires the most explanation. Eligible Canadian dividends, paid by Canadian corporations that have already paid corporate tax on their profits, receive the most favorable tax treatment of any investment income in Canada. At $80,000 Ontario income, the effective tax rate on eligible Canadian dividends is approximately 24.81%. Wait, that looks higher than capital gains. But here is what is not visible in that number yet. The gross-up and dividend tax credit mechanism means the actual after-tax cash position is considerably better than it appears. We will unpack that fully in Segment 2. The comparison at a glance: $10,000 of each income type, Ontario, $80,000 income. At first glance, capital gains look better than eligible dividends. And at this income level, they are, slightly. But the dividend tax credit has additional nuance. And at lower income levels, eligible Canadian dividends can be taxed at near zero or even negative effective rates. That is the part most people have never heard. Your action step: look at every investment you hold outside a registered account. Identify whether the income it generates is interest, foreign dividends, capital gains, or eligible Canadian dividends. The type determines the tax rate, and the tax rate determines how much of your return you actually keep. Here is the part of this video that most people have never had explained properly. When a Canadian corporation earns a profit and pays tax on it, and then pays some of that after-tax profit to shareholders as a dividend, those shareholders are receiving money that has already been taxed once at the corporate level. If Canada taxed that dividend again at the full personal rate, the same dollar of profit would be taxed twice, once in the corporation's hands and once in the shareholders' hands. That would be unfair, so Canada designed a system to prevent this. It is called the Dividend Gross-Up and Tax Credit Mechanism, and it works in 2 steps. Step 1. The gross-up. When you receive an eligible Canadian dividend, Canada grosses it up by 38%. This means the CRA treats your dividend as if it were larger than it actually was, to approximate the pre-tax profit that the corporation earned before paying corporate tax. Example: you receive a $1,000 eligible dividend from Royal Bank. The CRA grosses it up by 38%. $1,000 times 1.38 equals $1,380 grossed up dividend. Your taxable income is increased by $1,380, not $1,000. At first glance, this looks like bad news. Your taxable income just went up by $380 more than you actually received. Step 2. The dividend tax credit. Here is where the system corrects itself. Canada applies a dividend tax credit, both federal and provincial, that reduces the tax you owe on the grossed-up amount. The federal dividend tax credit for eligible dividends is 15.0198% of the grossed-up dividend. On a $1,000 dividend grossed up to $1,380, federal dividend tax credit, $1,380 times 15.0198% equals $207.27. In addition, Ontario applies a provincial dividend tax credit of approximately 10% of the grossed-up amount for eligible dividends. Provincial dividend tax credit: $1,380 times 10% equals $138. Total dividend tax credits applied: approximately $345.27 against the tax owing on $1,380 of grossed-up income. The net effect: at $80,000 Ontario income, the marginal rate on ordinary income is approximately 39.16%. Tax on $1,380 grossed-up dividend at 39.16%, approximately $540. Less federal plus provincial dividend tax credits of $345. Net tax on the original $1,000 eligible dividend, approximately $195. Effective tax rate, approximately 19.5% on the actual cash received. The income level where it gets really interesting. At lower income levels, the dividend tax credit becomes even more powerful. A Canadian with $50,000 in employment income in Ontario faces an effective tax rate on eligible dividends of approximately 6% to 8%. And here is the number that surprises almost everyone. A Canadian with no other income, relying solely on eligible Canadian dividends, can receive approximately $40,000 to $50,000 in annual dividend income in Ontario and pay zero federal income tax. The dividend tax credits fully offset the tax that would otherwise be owing. This is not a tax shelter. It is not aggressive planning. It is the intended design of the Canadian tax system, built specifically to prevent double taxation of corporate profits. Your action step on your next tax return. Find Box 24 on your T5 slip. That is your actual eligible dividend received. Box 25 is the grossed-up amount reported to CRA. Box 26 is the federal dividend tax credit. Now look at how much that credit reduced your actual tax bill. For most dividend investors, this calculation is a pleasant surprise. Here is one of the most common sources of confusion in Canadian dividend investing, and it catches a lot of investors off guard when they see their T5. Not all Canadian dividends are eligible dividends. There are two types of Canadian dividends, eligible and non-eligible, and they are taxed at meaningfully different rates. Eligible dividends are paid by Canadian public corporations, the big banks, Enbridge, TELUS, Canadian Tire, and most other large companies trading on the TSX. They qualify for the full 38% gross-up and the enhanced federal dividend tax credit of 15.0198%. Non-eligible dividends, sometimes called ordinary dividends or small business dividends, are typically paid by Canadian-controlled private corporations, CCPCs, that have benefited from the small business tax rate. They qualify for a lower gross-up of 15% and a lower federal dividend tax credit of 9.0301%. The tax difference. Ontario, $80,000 income, $10,000 dividend, on $10,000 in dividends. The difference in tax paid is approximately $1,117. This distinction matters most for Canadians who own shares in private companies or receive dividends from their own incorporated business, investors in certain income trusts, or smaller public companies that may pay non-eligible dividends. Anyone reviewing a T5 slip and trying to understand why the gross-up amount looks different from what they expected. For most everyday Canadian investors holding ETFs like VDY or individual bank shares, the dividends received will be eligible dividends, but it is worth verifying for every T5 slip you receive. The practical check on your T5 slip. Box 24 is for eligible dividends, and Box 25 is the grossed-up taxable amount at 138%. Box 10 is for non-eligible, ordinary dividends, and Box 11 is the grossed-up amount at 115%. If you see entries in Box 10 rather than Box 24, you are receiving non-eligible dividends and the tax treatment is less favorable. Your action step: pull out your last T5 slip. Check whether your dividends are in Box 24, eligible, or Box 10, non-eligible. If you are investing in Canadian ETFs, they will almost always be eligible. If you own shares in a private company, they may be non-eligible, and your accountant should be factoring this into your tax planning. Understanding how dividends are taxed is the foundation. But here is the strategy layer that takes that knowledge and turns it into real tax savings every year. In Canada, you have three main registered accounts that shelter investment income from tax: TFSA, Tax-Free Savings Account. All growth and income is completely tax-free. No tax on dividends, capital gains, or interest ever. RRSP, Registered Retirement Savings Plan. Contributions are tax-deductible. Growth is tax-deferred. Withdrawals are taxed as income. Non-registered account. No tax shelter. All income is taxed in the year it is received. The account you hold each investment in dramatically affects your after-tax return. The strategic question is, which investments belong in which account? The core principle: put your least tax-efficient investments in your most tax-sheltered accounts. Here is the hierarchy. TFSA, best for interest-bearing investments and foreign dividend payers, the two most heavily taxed income types. Inside a TFSA, a GIC paying 3.85% keeps all 3.85%. Outside a TFSA, at a 39.16% marginal rate, you keep approximately 2.34%. The TFSA eliminates that gap entirely. U.S. dividend-paying ETFs like VFV also benefit enormously from the TFSA, no U.S. withholding tax recovery complexity, and no Canadian tax on the dividends received. Note, there is one important exception. U.S. dividends inside a TFSA are still subject to the 15% U.S. withholding tax. And unlike an RRSP, the TFSA does not benefit from the Canada-U.S. tax treaty exemption on withholding. For this reason, some tax-efficient investors prefer to hold U.S. dividend payers in an RRSP rather than a TFSA, and hold Canadian dividend payers in a TFSA. RRSP, best for U.S. dividend-paying investments, because the Canada-U.S. tax treaty exempts RRSP accounts from the 15% U.S. withholding tax on dividends. VFV held in an RRSP receives dividends without the withholding tax that applies in a TFSA or non-registered account. Also appropriate for interest income and high-income earners who want to defer tax until retirement, ideally when their income and marginal rate will be lower. Non-registered account, best for Canadian eligible dividends and Canadian equity EETFs generating capital gains, because these are the most tax-efficient income types to receive in a non-registered account. The dividend tax credit reduces the rate significantly, and capital gains are only 50% included. If you must hold investments outside registered accounts, Canadian eligible dividends and long-term capital gains are the least expensive income types to receive there. The practical portfolio for most Canadians. For most Canadians with a TFSA, an RRSP, and potentially a non-registered account, the priority order is Max TFSA first. Invest in XEQT, VFV, or VDY. Canadian eligible dividends tax-free is excellent. Contribute to RRSP next, especially for high-income earners. Hold U.S. equity ETFs here for withholding tax efficiency. Non-registered account last. If needed, favor Canadian equity ETFs that generate eligible dividends and capital gains. Your action step: review where each of your investments is currently held. Is your GIC in a TFSA or a non-registered account? Is your US ETF in an RRSP, TFSA, or non-registered? Repositioning investments into more tax-efficient accounts without selling them is one of the highest return moves available to Canadian investors. Here is the vault from the opening, the account that makes Canadian dividend tax almost completely irrelevant for most everyday investors. The tax-free savings account. Not because dividends are not taxed inside a TFSA, they are not received as taxable income at all. Inside a TFSA, dividends are received, compounded, reinvested, and eventually withdrawn with zero tax at any point in the process. Let us put real numbers on what this means. The TFSA dividend scenario. A Canadian invests $7,000 per year into VDY, Canada's high dividend ETF, inside their TFSA. VDY's current yield is approximately 4.3%. With DRIP enabled, every monthly dividend automatically purchases more units. Over 30 years at an 8% total return, price appreciation plus dividends reinvested. Total contributions, $210,000. Portfolio value at year 30, approximately $862,000. Annual dividend income at 4.3% yield on $862,000, approximately $37,000 per year. Tax on that $37,000 in annual dividend income inside a TFSA, $0. The same portfolio in a non-registered account at a 24.81% effective dividend tax rate at $80,000 Ontario income would generate $37,000 in dividends and owe approximately $9,180 in annual tax. Over a 10-year retirement drawing that income, $91,800 in tax saved. From holding VDY in a TFSA rather than a non-registered account. This is not a sophisticated strategy. It does not require an accountant. It does not require understanding the gross-up mechanism or the dividend tax credit. It requires one decision: hold your dividend investments inside a TFSA. The 2026 TFSA numbers. Annual contribution limit, $7,000. Cumulative contribution room since 2009, $109,000 for anyone who has been eligible since the beginning. Eligible investments, stocks, ETFs, GICs, bonds, mutual funds. Growth, 100% tax-free. Withdrawals, 100% tax-free, anytime, no impact on government benefits. The most common TFSA mistake, and it is fixable. According to the Financial Consumer Agency of Canada, a significant portion of Canadians who have TFSAs hold only cash or low-interest savings deposits inside them. They have the account. They are not using the tax-free growth benefit. A TFSA holding cash at 2% earns $2,000 per year on $100,000 and pays zero tax on it. That sounds good. A TFSA holding VDY at 8% total return earns $8,000 per year on $100,000 and also pays zero tax on it. Same account, same tax treatment. $6,000 per year difference, entirely from what is held inside it. Your action step: log into your TFSA account today. Check what you are holding. If it is a savings account or GIC, check whether a low-cost Canadian dividend ETF like VDY or a global equity ETF like XEQT would be more appropriate for your time horizon. The tax treatment is identical. The return potential is not. Let's come back to where we started. Two Canadians. Both received $10,000 in investment income. Canadian A paid approximately $3,900 in tax. Canadian B paid approximately $390. Now you know exactly what created that gap. Canadian A received $10,000 in GIC interest in a non-registered account, taxed at the full marginal rate of 39.16%. No shelter. No credit. The most expensive form of investment income in Canada, held in the least protected way. Canadian B received $10,000 in eligible Canadian dividends inside a TFSA, tax owing 0. Dividend tax credits, irrelevant inside a registered account. The most tax-efficient income type, in the most tax-sheltered account. Same amount, same country. $3,510 difference. Here is what this video covered. 1. Canada taxes 4 types of investment income at completely different rates. Interest income is the most expensive. Eligible Canadian dividends are among the most efficient, especially at lower income levels. 2. The gross-up and dividend tax credit mechanism exists specifically to prevent double taxation of corporate profits. At low income levels, it can reduce the effective tax rate on eligible dividends to near 0. 3. Not all Canadian dividends are equal. Eligible dividends from public corporations receive better tax treatment than non-eligible dividends from private companies. 4. Where you hold an investment matters as much as what you hold. The right account for the right investment type can save thousands per year. 5. For most Canadians, the TFSA makes dividend taxation almost completely irrelevant. All dividends received, compounded, and withdrawn inside a TFSA are tax-free at every stage. You do not need to master every corner of Canadian tax law, but you do need to understand these 5 principles, because they determine how much of your investment return you actually keep.